Hello, everyone. I'm Maitri Sangoi on behalf of Women and Young Members Excellence Committee of ICAI. Welcome you all in the Sky High Symposium Series 60. Sky High Symposium is a Wednesday series of programs conducted by the Committee for the Women and Young Members. It is one of the Women and Young Members Excellence Committee's initiatives to not only disseminate information to members on technical updation and non-technical skills, but also to empower and inspire them to come at forefront and realize their verbal skills at a public forum. Today, we are going to cover a session on e-invoicing under GST and common non-compliances in financial statements. For our first session, we have CA Hiloni Gala, who is a highly experienced chartered accountant specializing in indirect taxation with a specific focus on GST. With over 5 years of experience in this field, Hiloni has established herself as a leading expert and has contributed significantly to her firm's success as a partner. She possesses an in-depth understanding of GST laws, regulations, and procedures. She specializes in GST compliance, including registration, filing returns, and handling audits. Over the years, she has dedicated her expertise to understanding the complexities of GST legislation and providing valuable insights to clients across various industries. She has successfully represented clients in GST litigation matters, including disputes, refunds, appeals, assessments. Her in-depth knowledge of GST laws and procedures, coupled with her strong analytical skills, has enabled her to effectively handle complex litigation cases. Hiloni has dedicated her expertise to understanding the complexities of GST legislation and providing valuable insights to clients across various industries. She has helped clients navigate the GST landscape, ensuring compliance and optimizing tax strategies. As a partner, she actively contributes to the growth and development of her team. She leads by example, providing guidance and mentoring junior members and fostering a collaborative work environment. CA Hiloni Gala, we thank you for your valuable time. Over to you.
Hello, am I audible?
Yes, ma'am, you're audible.
Okay. So I would like to thank the committee for giving me a platform and a chance to represent myself. And I would like to thank Maitri for this wonderful introduction. So what time can we start? Like, are we going to start right now only? Or are we waiting for someone to join?
No, ma'am, you can start now.
Okay. So basically, I'm here to guide you on e-invoicing under GST. This is very burning topic nowadays. So let's start. So what is e-invoice? So as per Rule 48.4 of CGST rules, some notified class of registered persons shall prepare an invoice by incorporating IRN number, which is invoice reference number, and QR code generated from the IRP portal on the e-invoice. So today, before e-invoicing came, we heard the term of tax invoice. And tax invoice was issued by the registered taxpayer for the tax charged by them. But now, as the e-invoice has enabled, so we need to fix two other criteria like IRN number and QR code on the tax invoices. So that will become e-invoice. Such invoice containing inter alia the QR code embedded with IRN number, which is issued by the supplier to the buyer, is commonly referred as e-invoice under GST. So earlier it used to termed as tax invoice because that was only tax, which was separately shown. But now we are going to show IRN number and QR code, so that will become e-invoice. Please note that e-invoice doesn't mean generation of invoice on the government portal or issue of invoice in PDF form. So invoice needs to be prepared at at customer registered person's place, like taxpayer or a supplier will create invoice and he will just put IRN number and QR code on the invoice. That doesn't mean that he need to prepare an e-invoice on the government portal. No, the government portal helps to create IRN number and QR code. So we will in deep we will learn how IRN number and QR code is getting generated from this portal, IRP portal. So there are some there are some advantages of e-invoicing. So this is widely framed over here. First one of the most you can say one of the most crucial advantage of the e-invoicing is smooth ITC reconciliation by auto reporting of invoices into GST return. So the moment invoices is created from IRP portal, the same gets reflected into GST portal. So there is smooth transition from IRP portal to e-invoice portal, and there will be ultimately smooth reconciliation from customer's point of view. Simultaneous generation of e-way bill. So e-way bill is also getting generated from e-invoice data. Utmost reliability, so no need to doubt the genuineness as it eliminates fake invoices. So no one is going to generate any fake invoices on e-invoice portal. Reconciliation problems are being eliminated, same ITC reconciliation and all the fake invoices and other reconciliation issues are getting eliminated over here. Standardization and eliminates data entry errors. So there is some standard format. So that will help customers to get the data in same format. Documents become tax compliant on real time basis. So the moment someone issues a supplier issues a tax invoice, that that is on real time basis, the same will get reflected on GST portal. So it will be a real time practice and he will be a tax compliant. Reduction of processing cost and improve payment cycles. So if person is getting credit on time, then there will be no problem of mismatches and payments getting delayed. So there will be reduction in cost, thereby greatly improving overall business efficiency and ensure ease of doing business. So that will so this is vicious cycle. If someone is giving invoice, then it has to be tax invoice, it has to be e-invoice. The same will be getting reflected on GST portal of supplier, and once he files the return, the same will be getting reflected on the portal of the customer. So and customer will get the benefit of ITC. He will make the payment on time, and same way the working capital flows smoothly. So that will be ease of doing business. So there are some list of abbreviations over here I have mentioned. We will discuss it. First one is IRP, that is the portal, that is invoice registration portal of the government. Just like GST invoice portal, there is one another portal is there, that is invoice registration portal, on which we will get IRN number and QR code. What is IRN? So IRN is invoice reference number, that is to be embedded on tax invoice generated by the supplier. API, application program interface. So there could be any program that will become an interface between IRP portal and the system used by the supplier. So that will be API, and the same way GSP. GSP is goods and service tax suvidha provider. And QR code. QR code is quick response. QR code, we all know what is QR code. Just like UPI ID and Paytm QR code we have, same way QR code will be here. So am I going too fast or too slow or anything you want me to clarify till now? Maitri or any other person can. Anything you want me to explain anyone or anyone is having query, or am I going any fast or okay, thank you. So what is the process? So earlier we used to follow only one process, that supplier gives the goods or services, and that will they will create tax invoices, and they will give it to the person who is his customer or client. Now the process is much more wider. So supplier will give services or goods, and he will form a pro forma invoices before going to final invoices. So he will prepare one pro forma type invoices, and he will put the data on IRP portal. So IRP portal will take that data, and they will process it, and they will create one IRN number and QR code. That QR code and IRN number will be fixed on the pro forma invoice, and that pro forma invoice will become tax invoice. So apart from having all the credentials of tax invoice, now it will have QR code and IRN number, and that will become e-invoice under GST. So here is the process. See, the supplier is here. So seller to have a system or offline utility to prepare a JSON. So IRP portal is going to get the JSON file. Okay. So upload e-invoice JSON to IRP portal as per the schema. So IRP portal will validate the data, and it will generate IRN number, and will send the invoice payload to the GST system. So once the IRN number is generated and given it to supplier, the same moment the data will flow to the GST system, and GST system will save the data, save the invoice details in the GST system, and auto populates in GSTR 1 and 2A of the client. Once it is done, adds a QR code and signs the JSON, pushes the data to e-way bill system. So simultaneously the data is flowing to the GST system and e-way bill system. And finally, the data is getting at the end of the to the supplier, and that will create JSON file, and e-invoice can be prepared, and e-invoice can be issued to the client or customer. So buyer can view e-invoice details in their GSTR 2A. So buyer's duty will be like they need to see details of invoices in GSTR 2A. Earlier, GSTR 2A was getting reflected, but the GSTR 2A was not having details of IRN number or the source. But as of now, they will see the correct IRN number and source. So when to issue e-invoice? So that is intact. Like once the invoice is generated, the simultaneously e-invoice needs to be generated. So the time limit to issue e-invoice is for the goods. If it involves movement of goods, then at the time of removal, and if does not involve movement of goods, then at the time of delivery. And if it is on sale or return basis, then supply before or at the time of supply, or within 6 months from the removal, whichever is earlier. So the the concept of generating e-invoice is same as the concept of generating tax invoice. And in case of services, then within 30 days of from the date of supply of services, and in case of banking and insurance, the period will be 45 days. So the ones tax invoice is need to be generated the same way e-invoice need to be generated. The only difference is e-invoice will contain IRN number and QR code. We will see the phase-wise applicability of e-invoicing. So first of all, first the e-invoice rollout in the month of September, where it was mentioned that the turnover of more than 500 crore in any of the tax period earlier in the GST era, then the person who is having turnover of more than 500 crore needs to start e-invoicing from 1st October 2020. So the notification number is mentioned over here, and the turnover is mentioned over here. In same way, the turnover was getting reduced from 500 to 100. So the 100 crore turnover entities were getting affected for generating e-invoices. So 100 crore was applicable from 1st January 2021. Same 50 crores, 20 crores, 10 crores, and 5 crores. So the 5 crore was applicable from 1st August 2023. So in the month of August, the turnover, if the turnover of any preceding financial year exceeds 5 crore, then the same will be applicable. E-invoicing will be applicable from August 2023 onwards. So there are some sources which has confirmed the GST Council may reduce the turnover limit to 1.5 crore from December 2023 or January 2024 in the upcoming council meeting. So they are on the radar of coming under the purview of e-invoicing. What is the penalty? So penalty for non-issuance of e-invoice is 100% of the tax due or 10,000, whichever is higher, and the penalty for incorrect e-invoicing is 25,000. There are certain exemptions given to e-entities for e-invoicing. Like irrespective of the turnover, e-invoicing shall not be applicable to following categories of registered persons, like an insurer or a banking company or a financial institution, including NBFCs, goods transport agency, a registered person supplying passenger transportation services, a registered person supplying services by way of admission to exhibition of cinematographic films in a multiplex services, an SEZ unit, and a government department or a local authority. Since they have a lot of transaction and most of the transactions are in the form of B2CS, so they have the government has given them the exemption to not to issue e-invoices, but certain government department or local authorities are issuing e-invoicing to for better compliance on their part. So what type of documents and supplies are covered under e-invoicing? So documents are you need to show invoices, normal tax invoices, credit notes, debit notes, and invoice cum bill of supply. These types of documents can be shown under e-invoice portal. And which type of supply are covered? So the supplies are B2B supplies to SEZ, irrespective of with or without payment, exports with and without payment, and deemed exports. So these are the types of supplies which are covered under e-invoice, and these are the types of documents which are covered under e-invoices. So a combination of these two will create e-invoice. If B2B supplies are made and invoices are prepared, tax invoices, then that will be covered under e-invoice. B2B supplies made and credit notes are issued, then the same will be covered under e-invoice. Same way, permutation combination between these two will get attracted to e-invoice. Documents and supplies covered will include QR code for B2B, B2CS transaction. Generally e-invoicing is applicable to B2B supplies only, where the customer is registered. But in some cases, B2CS invoices are also considered, and they need to produce dynamic QR code on their own. This is not getting covered from that is not getting generated from the IRP portal. This needs to be created by the vendor on its own. And as the name suggests, it is dynamic QR code. It gets updated as the invoice is getting updated. The QR code will get updated. But in case of e-invoicing, the data will get locked. How to report to IRP portal, like how to report the details of invoices on invoice registration portal. How we file GST returns. So GST returns are getting filed from any software or from offline utility, and they will create some kind of JSON file, and that is getting uploaded on GST portal, and the returns are getting filed on that basis. But here, same way, here is modes are API based, both integration with taxpayer system directly, like we can integrate some software or API based any others GSP or ASP, and the system will get directly linked to the IRP portal, and they will create IRN number. Or other is integration with taxpayer through GSP or ASP. So same way, sometimes the system is getting integrated and sometimes the system is not getting integrated. So both way we can do, and government has given us the pre-offline Excel utility we can use for the bulk generation tool. So these are the types, like these are the modes where we can use this for reporting on e-invoice portal. So the government-based pre-offline utility has four types of Excel formats in A, B, C, D format. So based on the details and based on the credentials of the invoice, we can select any of the format and we can generate JS. We can validate the items and we can generate JSON file, and the same will the same will be loaded to the e-invoice portal for the generation of IRN number and QR code. Once the e-invoice data has been uploaded to IRP portal, the same will be getting downloaded in Excel format. The Excel file contains the document-wise details reported on the IRP portal and the following details for all the documents. So these are the details which will be mentioned in the Excel file, which is getting generated from IRP portal for the data we have uploaded. For each and every document, we will get IRN number, which is 64 string hash, date of IRN number, e-invoice status, like is it valid or cancelled, date of auto population or deletion upon cancellation. So the date on which the auto population or deletion has been done, GSTR1 auto population or deletion status. So whether the data has been populated on GSTR1 portal or not. So same, the status will be like auto populated or deleted, or auto population failed or deletion failed. The same will be getting reflected in the Excel format. Error in auto population or deletion, error description if any. So if there is any error, then same will get reflected in the Excel format. So we can correct it, and we can get it why this we can get the details why this error has happened. Now verification of e-invoice. Once the supplier is giving e-invoice, we need to verify that whether it is correct or incorrect. So one can verify the authenticity or correctness of e-invoice by uploading signed JSON file or QR code into e-invoice system. That is, e-invoice portal have the this string. They have one tab for checking the authenticity or the correctness of the e-invoice. The IRN number you can mention over there, and you can also mention the you can also put the signed copy of the invoice, and you can get the details of the iron invoice. Alternatively, with QR code on mobile app also, we can see the details of the invoice. So we can just scan the QR code and we can get the details of the invoice. So we can check the invoice from these two methods. IRN cancellation. IRN can be cancelled within 24 hours from the date of generation of IRN. So once the invoice is uploaded on the e-invoice portal, the same can be cancelled within 24 hours. After 24 hours, the portal will not allow you to cancel or make any changes. They are not allowing to make any changes even within 24 hours. They can only get they can only be cancelled within 24 hours. So if you need to cancel any invoice, the same can be done within 24 hours. However, if the connected e-way bill is active or verified by the officer during transit, cancellation of IRN will not be permitted. So if the e-way bill, which is getting generated from IRB portal also, if it is active and verified by the officer, if the officer has verified the authenticity and correctness of the e-way bill, then the same cannot be cancelled. Upon cancellation, the data flows to GST system, and all cancelled documents which were appearing as saved documents in GSTR1 are deleted from GSTR1, and the status of the document will be updated in the Excel file from valid to cancel. So once the data is being cancelled from IRP portal, the same will be reflected on GSTR1 simultaneously, and the status will be from valid to deleted on GSTR1 portal. Document status is updated in Excel file upon cancellation of IRP, even if no further action is possible in GSTR1. So if GSTR1 is already filed, and if it is on the verge of filing, then the data of GSTR1 will be logged, but IRP portal will get updated data on day-to-day basis. E-invoice to GSTR1. The documents, that is invoices, debit notes and credit notes reported on IRP are transmitted electronically to GST system 2 days after generation and are auto-populated in respective tables of GSTR1 of such taxpayer. So earlier we used to create e-invoice and we used to report the same to GSTR1 manually. So now the system is on real-time basis, though not real-time, but it is getting 2 days time. But yes, the data is getting flow from IRP portal to GSTR1 portal within 2 days, and the same is getting auto-populated to respective table. If it is credit note, then the same will be reflected in the tab of credit note. If it is B2B invoices, the same will getting reflected to B2B invoices, and exports, the same will be getting reflected on export tab of the GSTR1. So the burden of filing GSTR1 is getting reduced. These auto-populated documents appear as saved records in GSTR1 of the taxpayer with source document mentioned as e-invoice, and IRN number details are also mentioned against every record. So the GSTR1, where the B2B invoices and debit notes, credit notes, export invoices are getting reflected from IRP portal, the same will show you the source of that document as e-invoice. The same will be marked as source as e-invoice, and the IRN number of the same will be getting reflected on the GSTR1 portal. So you can get to know that these details are reflected from e-invoice portal. The tax period of GSTR1 in which e-invoice will be auto-populated will be as per the document date, irrespective of the date on which the document was reported on IRP portal and the IRN number was generated. So the real point is the tax period of GSTR1 in which the e-invoice will be auto-populated will be as per document date. So if the document date is pertaining to previous month, the same will get reflected into the previous month's GSTR1. And if the document is pertaining to current one, the same will be gets reflected in current month GSTR 1. If the taxpayer reports the document, that is invoice, debit notes or credit note on IRB portal after filing of GSTR 1 for that period, then the e-invoice will not be auto-populated in any of the subsequent GSTR 1. As we discussed that the GSTR 1 will catch only the document date which is pertaining to that period. If the period is logged by filing the GSTR 1, then the same invoice will not get reflected in any of the subsequent GSTR 1. The Excel file containing the e-invoice details can still be downloaded from GSTR 1 dashboard for tax period to which the documents pertains to. The Excel file having the e-invoice detail can be downloaded from the GSTR 1 portal also. So you will get the details of e-invoice from the IRP portal also and from the GSTR 1 portal also. Both will get the data based on the information given to them. If the taxpayer reports the document on IRP portal after manual entering the document in GSTR 1, the manually entered data will not be overwritten even if the GSTR 1 is not filed. So the manually entered data will be considered as final if the data is from IRP portal is getting reflected, that the same will be overwritten if the manual intervention is done in the data. The Excel file containing the e-invoice details still can be downloaded from GSTR 1 dashboard of the tax period for which the document pertains to. The same has been covered earlier, that GSTR 1 will also show the dashboard of downloading the e-invoice data which is getting reflected from IRP portal. Since the document already exists in GSTR 1 and it is not auto-populated in GSTR 1 from IRP, a message regarding the same will be mentioned in the Excel file against the specific document. That if the documents is already existing in GSTR 1 and it was not generated from the IRP portal, then the message will be reflected that this has not been, the source will not be the e-invoice, the source will be the manual entry. GST system aggregates the item level details reported in e-invoice at rate level for the purpose of auto population into GSTR 1. So e-invoice may have a single invoice may have a different rate wise items in the same invoice. So the same will gets reflected in the GSTR 1 also. So there is no need to do any manual changes or manual intervention. The following additional details will also be displayed in GSTR 1. Earlier, GSTR 1 needs to be filed on your own. You need to upload the data. But now, since the data is getting reflected from IRP portal, the data will have these 3 columns for the reference purpose. That the source will show you the e-invoice, IRN number of the respective invoice, and IRN date. When the IRN was created, the date will be mentioned over there. If a taxpayer edits the data auto-populated in GSTR 1 from e-invoices, then such edited documents will be treated as if they were not auto-populated but uploaded separately by the taxpayer. As mentioned earlier, that the auto-populated data has 3 additional columns of source, IRN number, and IRN date. But if the auto-populated data is getting hampered by human intervention or manual entry, then the such edited documents will not be having these 3 columns of source, IRN number, and IRN date. The same will be deleted. Thus, the data auto-populated in the source, IRN and IRN date fields will be deleted by the system in such cases. So the same can be identified that there is some changes in the system. So the data will be the data source will not be e-invoice. Taxpayers are thus advised to modify or update the details of auto-populated data from e-invoice only if they are not as per the actual documents issued by them. So the taxpayers or the suppliers are advised not to modify or update any details which is getting auto-populated from IRP portal unless it is needed or unless it is not actual, not proper as per actual documents. However, these changes will be flagged to proper officer for information. If the quantum of the invoice is more, then the same may be flagged to the proper officer for information, and officer may ask you for the proper justification for changes made in the documents manually. E-invoice to GSTR1. So outward supplies details like HSN, B2CS documents, other details other than those reported on IRB portal have to be manually entered in GSTR1 as earlier. So we need to update B2CS, HSN code, advance adjustments, and other information in GSTR1 manually as we were doing earlier, as the same will not be getting reflected from IRB portal. Subsequent modification made by the taxpayer to auto-populated details in GSTR1 tables would not be reflected in these files. So Excel file will not hold any control if the taxpayer is changing any auto-populated data. Excel file will reflect only those data which is getting reflected from IRP portal. So major point is here, like what is the impact of e-invoicing on ITC? So the basic conditions of claiming ITC is the supplier the recipient should get the services or goods. They should make the payment in 180 days, and they should the invoice should get reflected in GSTR 2A. The supplier should file the GSTR 1. So apart from this, having just tax invoices not enough. We need to get the e-invoice from the supplier if e-invoice is applicable to them, as as per section 16.2, which outlines the conditions for claiming input tax credit. A registered person must fulfill this condition to avail the ITC, which includes possessing of a valid tax invoice, receiving goods or services, and ensuring that the tax has been paid by the supplier to the government. So Rule 48 of CGST rules is mentioning the manner of issuing invoice. So here we will get the manner which is on which basis the invoice should be issued. As per Rule 48.5, every invoice should be issued by the person to whom a sub-rule applies in a manner other than the manner specified in the sub-rule and shall not be treated as an invoice. So 48.4 says the invoice shall be prepared by such class of a registered person as may be notified by the government on recommendation of the council by including such particulars contained in Form GST Invoice 01. After obtaining IRN number by uploading information contained therein on the Common Goods GST electronic portal in such manner and subject to such conditions and restriction as may be specified. So here it is mentioned that the invoice should contain IRN number which is getting generated from the IRP portal. So unless the invoice has IRN number, the same will not be valid for claiming the ITC. So we need to check the applicability of e-invoice to the vendor, and the same can be incorporated in the system. If a registered person who is obligated to issue e-invoices fails to provide the invoice becomes invalid, and as a result, basic condition to avail ITC is not getting fulfilled, and the recipient cannot claim ITC. To rectify such issue, it is crucial for accounting system to have a mechanism indicating whether the supplier needs to issue e-invoice. Additionally, various tools can be utilized to verify the authenticity of the e-invoice applicability mentioned earlier. So we need to check at each point of time that whether the vendor or supplier is getting covered under the e-invoice umbrella. If they are getting hit by the e-invoicing applicability, then we need to ask for e-invoice and not for the tax invoice. So there are some common errors which is there are some errors which is getting reflected in day-to-day practices or day-to-day uploading of e-invoicing. I am covering here some of the errors and solution for the same. Duplicate IRN. If attempting to register a document again which is already registered and the IRN is already generated. So basic fundamental principle of getting IRN generated is there should not be any duplication of invoice entry, invoice number. So invoice number, if the particular invoice is being generated from the IRP portal and IRN number is generated, then the same document number will not be accepted by the IRP portal. So duplication of invoice number will be eliminated at this stage only. Second is interest for intrastate transaction, IGST amount is not applicable, and same way CGST, SGST amount is applicable. So if we have selected the invoice type as intrastate, then the amount should be entered in CGST, SGST column rather than entering in IGST column. And if the amount is entered in IGST column, then the error will be reflected that this type of error is there. So IGST amount is being passed for intrastate transaction, whereas CGST and SGST are applicable. Same goes with IGST. If interstate transaction is selected, then we need to enter only IGST amount and not CGST, SGST. Then the same amount, the same error will be reflected. So we need to check whether it is intrastate and interstate. If it is intrastate, then CGST, SGST is applicable, and if it is interstate, then IGST will be applicable and the same amount needs to be entered. Invalid HSN code or SEC code. So if we attempt to enter any invalid HSN code or SEC code, then system will get the error and we need to correct it. Taxable value of all items must be equal to total taxable value. So there are multiple columns of entering taxable value in the Excel file of this bulk generation tools. So all taxable values should match with each other. Even any deviation in decimal will not be entered over here. So we need to check the taxable value flows correctly and simultaneously synchronized with each and every taxable value. And taxable value is the value of all the line items getting reflected in the same row. Invalid total invoice value. Same way, if the invoice value is, if the invoice value is wrongly entered between two and if there is deviation in two columns of invoice value, then the same will be reflected. And invoice value should have amount of taxable value, CGST, SGST discount, that all should be considered while calculating invoice value, and two columns of invoice value should be same. Assessment value should be equal to total amount minus discount amount for HSN. Same way, assessment value should be like taxable value. Incorrect assessable amount is passed for the specified item, then this error will be reflected. If we need to enter the total amount minus discount, that will be your assessable value for the purpose of tax. Invalid total of item value of HSN. So HSN wise item value needs to be corrected. Total item value passed is incorrect. If the total item value is incorrect, then the same will be reflected. So you need to check the HSN wise item total, and the same will be the same needs to be entered in total value item for the particular HSN. supplier and recipient GST number should not be same. This is the basic principle of generating e-invoice or entering any invoice details into GST portal, that they will not accept the GST number of the supplier. So we need to check the supplier and the recipient number are not same. The recipient GST number cannot be URP for the supply type. Uh, if the recipient is having GST number, then you cannot enter URP, that is for unregistered person. We use the term URP while it is export or yes, while it is export, then the person is not having the GST number because the person is sitting outside India and they don't have any GST number. So we put URP. But for the purpose of B2B supply, we need to have a GST number, and we cannot put URP or unregistered person for in the column of GST number. Correct GST number should be entered for B2B type transaction. Otherwise, the same will be considered as B2CS. And B2CS transaction need not prepare e-invoices. Basic CGST and SGST amount should be equal. Sometimes it may happen that CGST, SGST amounts are varying because of some decimals. Let's say 100.01, and we have put 100.10 in CGST and SGST column. If the amount is different of CGST and SGST, and SGST is not matching, then the error will get reflected, and we need to correct, and we need to check why this error is getting reflected. Duplicate serial number are not allowed. So we need to put if an invoice is having multiple GST rates. Say if a stationary person is giving B2B invoice and it has 5%, 12%, 18% line items, and different line items have different serial numbers. So we need to put different serial number, even the document is pertaining to same serial number. Invalid SGST, CGST amount for HSN. Same way, CGST, SGST and SGST, CGST amount should be equal. Wrong IGST amount is passed in specified item list with the HSN. Same way, the CGST, SGST and IGST amount needs to be calculated based on the rate and the taxable value. If there is some mismatch, then we should correct it manually. Otherwise, the form bulk generation tool will not accept the will not validate the Excel file and will not generate the JSON file further for uploading on IRP portal. Wrong GST rate is passed for the specified items in the list. So standard rates of the GST are 0, 0.5, 1, 2, 3, 5, 12, 18 and 28. But if we put 12.5 or 5.5 or 2.5, then the tool will not accept the rate, and it will reflect error. So we need to check the GST rate before entering into Excel or bulk generation tool or any of the API or GSP you use. Recipient PIN code is mandatory for transaction. So recipient PIN code is very much mandatory. We cannot put any PIN code other than the required or the correct PIN code. And if it is export, then we put 99999 for the PIN code. Recipient GST state code should be same as per the state code passed in the recipient details. So recipient code should be matched with the state you have selected in the Excel and the GST number you have put in the GST number column of the recipient, and so everything should be aligned in alignment of each other. Recipient PIN code should be 99999 for direct export. For export, we put 999999 PIN code. GST number is not present in the invoice system. This error is frequently getting reflected on the portal on the Excel tool, because some recipients are getting cancelled or getting invalid. So we need to check the status of the GST number. If it is correct, then only GST portal, this IRP portal will accept it. Otherwise, it will not accept, and we need to check we need to check it with the vendor why the GST number is cancelled or invalid, or any other reason we can check with. GST number is inactive. Same, if it is inactive and cancelled by the department, we need to check with the vendor whether the GST number is active or not. And if it is not active, then the same will be treated as B2CS supply and not B2B supply. There are some FAQs on e-invoicing we can discuss over here. So some of the FAQs are: whenever I'm trying to log in, the system says your account has been blocked. Please try after some time or 5 minutes. So how should I resolve this issue? So there could be a reason that you have put any wrong login credential and the account gets blocked. But it's okay. After 5 to 10 minutes, the account is active, and you can re-log in with the correct credential, or you can reset the login credential if you have forgotten the same. And e-way bill's login credentials can also be used on e-invoice portal, so we can use that credentials also on this portal. Why do I need sub users? So unlike GST and e-way bill, we have the facility of creating sub users on e-invoicing portal. So what is the use? Most of the times the taxpayer or authorized person himself cannot operate and generate IRN number. So many a times it happens that the authorized person is CFO or CEO or any other manager or any other designated person of the assessee. So they cannot sit and they cannot generate IRN number. So he will be dependent on his staff and operator to do that. So he would not like to share his user credential to them. So we have solution for this, and we can create sub users. So depending upon the department and the nature of the transitions, assessee can create sub users for the various departments or various users, and respective user can log in with their credentials, and they can create e-invoice from their own login credentials. How many sub users can be created? So if for every principal or additional place of business, user can create maximum of 10 sub users. So if a taxpayer has only one principal place of business, then he can create 10 sub users. If the taxpayer has 3 additional place of business and 1 principal place of business, so in multiple of 10 and having 4 places, then he can create maximum up to 40 sub users. Under user management, you can create, freeze, update sub users. So you can have a track of creating, freezing, and updating the sub user from e-invoice portal. Why are the reports available only for a particular day? The user is allowed to generate report on a daily basis because criticality of the system for performance for 24/7 operation, the reports are limited to be generated for a day. The user can change the date and generate the report for that date. Hence, the user is advised to generate report on daily basis and save the same in his system. So the report is getting generated for a particular day and for the particular day. So we suggest that at the end of each day, we should create the report and we should save it in the portal. We should save it in the server or the system for future reference. What is the maximum number of line item which can be reported in an invoice? So right now it is 1,000 presently, but it can get enhanced based on the requirement in future. So at a time you can generate 1,000 e-invoice at a time. In our business, we have a practice of showing negative values in an items for an invoice, like underloading, penalty, deduction. How to report the same in the invoice? So e-invoice does not have any particular column for each and every nomenclature used by the businessman. So we can put the same, like for deduction or penalty or underloading, we can put the same into the one column which is called as item discount amount. So in the line item details, such values can be shown in the item discount amount. Being discount, the value is automatically treated as negative, and the correct value will be reflected in taxable value and total value. So you can put it under discount and the same will be accounted. In e-invoice schema, there is no placeholder for mentioning TCS collected by the supplier under income tax. Then what to do? The same needs to be reported under other charges at the invoice level and can be used to mention as TCS where it doesn't form part of the taxable value. So you can put the amount of TCS under the heading of other charges and same will be accounted. For generating IRN, whether the GST number of the supplier and recipient should be active on the system. Yes, it is very much mandatory. If any of the GST number is not active or invalid or cancelled, then the purpose of the IRN will not be served. So yes, as e-invoicing is mandated for a specified registered person to other specified registered person to other registered person, both GST number of the supplier and the recipient shall be active in the GST system and as on the date of documents being reported. So when the document is getting reported or uploaded on IRB portal, both GST numbers should be active. Otherwise, the system will not accept the data. Can an invoice number of a cancelled IRN can be used again? No, it is very much unique. Once the IRN number is cancelled, the concerned invoice cannot be used again to generate the another e-invoice or IRN. If it is used again, then the same will be rejected, and when it is the same will be rejected when it is tried to be uploaded on the IRB portal. So document number is unique for the IRB portal, and the portal will not accept the duplicate document number. I have generated IRN number for an invoice. There is discrepancy in the invoice and supplied also didn't materialize. So I had to cancel it in my system. However, I could not cancel the IRN number on IRB portal as the cancellation window is working for 24 hours and the same has been expired. What to do? So many times it happens that the invoice is generated, but the supply is not made or services are not provided. And after 24 hours, as the system has accepted the invoice, you cannot cancel after 24 hours. So what to do? So basic principle is to generate credit note and the same needs to be reported on IRN portal, and simultaneously that will flow from IRB portal to GST portal, and both invoice and credit note both will be appearing in the GST return. So no need to worry. We can create a debit note and credit note in support of such documents. Upon generation of IRN, amendments are not possible on IRP, and cancellation of IRN only is permitted within a time window. So the details of invoices actually issued during the tax period have to be reported in GSTR1. In the e-invoices, auto-populated GSTR1 tables, taxpayers shall not delete the details. Separate credit note has to be generated along with IRN. So as I have explained earlier, that we should prepare credit note or debit note to uh, to amend the details which have already shown on IRP portal through credit note and debit note, and the credit note and debit note should also be generated with IRN. Once summary is generated, then IRN number will not be auto-populated in GSTR1. Also, this invoice is having remark as written filed in the Excel file. So if this is done after filing GST return, the same will not be getting reflected on the GST portal, and return is filed, so the data is logged. You need to, if you need to show, if the invoice has been shown and credit note is shown later on, then we can show it in the next month manually in GSTR1. So the data will not be getting hampered, and the books will tally with the GST returns. So for more FAQs, you can refer this website of e-invoice portal. And thank you for listening patiently.
Thank you very much. You have explained in detail invoicing procedure, and I'm sure that many of the doubts of the participants has been cleared. There is one doubt in Q&A. Can a registered person with a turnover less than 5 CR and called e-invoice, is he required to issue invoice for every supply, or he has got the option to issue tax invoice instead of e-invoice for certain supplies? So
So
the turnover
e-invoice
is less than
5 crore, less than 5 crore.
yeah.
So if the turnover is less than 5 crore, right now it is not mandatory to issue any invoice, but for they will be covered if the government may come up with the notification to uh, to cover 1.5 CR turnover. So the same will be getting affected. So
But
here I have mentioned the phase-wise applicability. So you can refer the same.
okay, but for whatever reason he has enabled the invoice. So is there any option for some invoices he issue invoice, and for some invoices he issue documentary invoices?
No, no,
Is there
no.
any
If
such option?
if e-invoice is applicable to a taxpayer, then he need to report e-invoice only for B2B supplies.
Okay.
Only B2B supplies are covered. No
Okay.
B2CS.
Okay. And actually, this is the case for one of my client, that while filing GSTR1, the tax invoice numbers are not matched with e-invoices. So
Yes, that
every
happens.
invoice is reflected double in GSTR1.
That happens. That happens. So we can do one thing, like same happens with our clients also. So we just download the JSON file from the GSTA portal on from the download portal, and we manually delete the irrelevant items, and we again upload the same data, so IRN number of the correct details will not get hampered.
Okay. Thank you very much, Dalaman. You have explained very nicely, and this is the requirement as of now, as because many of clients having more turnover but not aware about the invoicing procedures, and they are facing many difficulties and glitches while generating invoices.
Yes.
And what if invoice is wrongly generated, and on invoicing portal invoices are available only for 3 days? So how we can cancel that invoice? What is the remedy on that?
We can create credit note for the same.
Okay.
We can create a
Yeah.
credit note, and we can
Thank you.
upload the same on the IRB portal, so that will be accounted.
So for credit note also you have to issue invoice.
Yes, yes. If the party is registered, then yes.
Okay. Thank you very much. And we are having very nice session, and our next speaker has already joined. And we are very nice session on India's. Hello.
Hello.
Yeah, Shweta ma'am.
Yes, ma'am. I'll just share my screen also.
Yeah, okay.
Yes, ma'am.
Thank you very much. We have second session on common non-compliances in financial statement, and for that purpose, we have expert speaker CA Shweta Doshi with us. She is a rank holder in CA intermediate exam and completed her diploma in IFRS by ACCA UK. She is IAAPI registered valuer and has completed certificate course on forensic accounting and fraud detection by ICAI. She is having wide work experience with various firms. Currently, she is partner in Doshi RCM company, heading the internal audit, valuation, and AS division of the firm. She has been trained at Grant Thornton LLP Mumbai on IFRS ACCA courses. She has been senior consultant at Finpro Consulting firm specialized in Ind AS from June 15 to June 19. She has completed her articleship from GD Apte and Company leading from Pune. She has very training experience also. She is actively involved in providing training to ICAI students at ICAI PCMC branches. Conducted 40 plus Ind AS training for listed companies, various corporates, and webinars on various forums. She has delivered lectures on CA Sansar, a leading knowledge foundation website. IFRS, India, CA gap coverages have converted more than 25 top companies, which are majority listed into India, has conducted various webinars on different Indias, has consulted US-based companies on IFRS 16. She has contributed to development of content for National Institute of Banking and Finance. She's been part of development of software designed for the Ind AS 116 leases. She has been actively involved in preparation of IFRS and Ind AS training manual. She has formulated research paper for submission to ICAI on IFRS 16 and IFRS 15. Carried valuation in accordance with Ind AS 113 for the Ind AS companies. Have prepared Ind AS financial statements for DRHP purposes. She has carried process audit reviews and process documentation of large scale private companies, has carried valuation of employee stock options, has undertaken various other with this introduction. We welcome Svetlana ma'am and hand over the session with you. Thank you, ma'am.
Thank you so much for the opportunity given for conducting this session on common non-compliances in the financial statements. And thank you, ma'am, for your kind introduction. So, friends, a very good evening. This is a May month, June month, which is a peculiar for your completing the audit of financial statements. September is a due date where all the corporate financial statements are to be completed. So the auditors, we, the group of chartered accountants, we have, this is the most prone area, that is the statutory audit of financial statements, which is going to be completed in this period. So I would like to highlight upon this topic, that is common non-compliances in the financial statements. So here I'm going to cover area by area which are commonly observed non-compliances in the financial statements, so that we are cautious about these all non-compliances, and whenever we are completing any audit of any financial statements, we should be careful about these all areas. Just to highlight upon, FRRB is one of the board financial reporting review board of ICAI, which conducts this entire detailed analysis of the non-compliances that are happening in the financial statements. So the board gives you standard by standard analysis of what are the common non-compliances, where we prone to make errors as a chartered accountants, a very good publications that are generated by the FRRB. So even my content is a lot from that FRRB publication itself. So as a fraternity, if we focus on these all non-compliances, I expect that a lot more qualitative financial statements will be generated and audited by the our group of chartered accountants. So let us start. In this entire slide deck per se, I have given references to ASS, the accounting standards, because the majority of the committee are well versed about the accounting standards. These all non-compliances are also as it is applicable in Ind AS also. Wherever there is a difference, I will highlight those kind of differences so that we are aware about the both kind of the non-compliances. So let us begin with common non-compliances regarding share capital in the financial statements. A very common non-compliance observed is, as we are aware, as per the Schedule 3, you are required to disclose the rights, the preferences of the in respect of shares that are assigned. So commonly people only give the share capital note, the schedule, and they don't disclose the rights, preferences and restrictions attached to that shares. Further, a reconciliation also has to be given where opening balance is there. Even if there is no change during the period, you still have to give the reconciliation of opening number of shares, additions during the period, deletions or any buyback during the period, and then the closing number of shares. So, and plus this has to be given on a class by class basis. So if you have multiple class of equity shares, you have preference shares, which are classified as equity, you have to give these all disclosures for all these line items. So a commonly observed error is this is missed out, or even if it is disclosed, say particularly to the equity share capital, it is disclosed. If the company is having preference share capital, they do not give the rights, the preferences, what are the reconciliations, opening shares, these are skipped when the audited financial statements are disclosed or are audited by the our group of chartered accountants. Second, a very commonly observed error is one more disclosure is required to be given is wherever the shareholding is more than 5% in any particular company, you have to disclose the same. Additionally, if any company is your holding company or subsidiary company, that also has to be disclosed in your share capital note when you are disclosing the in your notes to the financial statements. So companies are disclosing the 5% shares, and it has been observed that certain companies are exceeding 20%, their associate companies, they're exceeding 50%, their holding companies or subsidiary companies. Still, the note of holding company is not disclosed in the financial statements, which is again resulting in a non-compliance to the disclosures required as per the Schedule 3. Second, one more important aspect is wherever there is an unpaid option in any call. Recently, it is not a predominant phenomena, but in the previously older financial statements, this is shown on a net basis, whereas you have to show the gross amount, you have to show whatever is pending, that is unpaid, and then show the net amount. So this is again one more important thing. Third, a really important and a really common phenomena is share application money pending allotment. This is also reflected as a part of share capital itself. But friends, this has to be disclosed separately as a separate line item in your balance sheet per se, and it cannot be merged with your share capital because this is not yet allotted. This is pending allotment. So on the face of the balance sheet, you will have to disclose the share application money pending allotment, and you cannot merge it with the share capital per se. So this is a very commonly observed non-compliance. With respect to Ind AS in this aspect, share application money pending for allotment also forms a part of statement of changes in equity, SOCI. Even there in that statement also, it has to be disclosed as a separate column, and the reconciliation of share application money pending allotment has to be given as a part of statement of changes in equity. Moving ahead, one more thing to highlight. Additionally, Schedule 3 was amended 2 years back. So in that also, the disclosure required was promoters of the company. So even if you're giving this 5% disclosure of shareholders holding more than 5%, people skip on to give the shares held by the promoters of the company. So even that is additionally required by the amended Schedule 3, which is again skipped by multiple companies. So promoters of the company might hold 5%, might hold less than 5%, but as per the secretarial records, whoever are the promoters of the company, shares held by those promoters, and if there is any change during the year with respect to the shares held by these kind of promoters, are also to be disclosed. So you cannot say that 5% I have disclosed, so promoters is not required. No, not acceptable. Promoters shareholding is to be disclosed by way of a separate table to the financial statements. Moving ahead, non-compliances regarding the reserves and surplus. So what is commonly observed error is, in case of reserves and surplus, people disclose it as a single closing line item, whereas the Schedule 3 requires to disclose it as a reconciliation. What was the opening balance? What is the change during the year? Addition or deduction in the form of addition or deduction, and then the closing balance. So you cannot show only single line item as a closing balance into your notes to the financial statements in your reserves and surplus schedule. Secondly, this reconciliation is shown for the surplus in the statement of P&L because you have add profits less any dividends distributes closing balance. But for other reserves such as capital reserve, any other reserve such as I'll say securities premium, they don't show this kind of reconciliation. For these reserves, it is common to show just one balance as a closing balance. Why? There is no discrimination required. For every reserves, you will have to show the reconciliation, opening balance and the closing balance per se. So that is one important point to be highlighted. Secondly, even till today, many companies, if there is a loss balance in the reserves and surplus, they show it in the asset side, which is absolutely incorrect. Long back, this has been amended and you have to show it as a negative figure in your reserves and surplus schedule. Even on the face of the balance sheet, even if the net amount is negative, you will have to show it as a negative amount in the equity and liabilities side itself. You cannot show it in the asset side. So this is one important, one important error which is peculiarly observed. Thirdly, in respect of Ind AS financial statements, it is mandatory that for each and every reserves and surplus, you disclose the nature of each reserves. What does that reserves mean? Okay, so if there's a capital reserve, you cannot just end up by writing the word capital reserve in the schedule. Below the schedule, you will have to write why has this capital reserve arisen, from what transaction it has arisen, some details about the reserves. So nature of the reserves has to be disclosed. This is very commonly missed by the, in the financial statements that do not disclose any nature of the reserves and surplus. Whatever is appearing in your reserves and surplus schedule, nature of each and every line item has to be disclosed in your financial statements. Moving ahead to non-compliances regarding long-term and short-term borrowings. So we are going line by line item, whatever is a non-compliance is there. In case of long-term and short-term borrowings, the security that is offered for the borrowing is commonly missed. So if there are 4 loans, people feel that only wherever property is given as a security or these kind of things are only to be disclosed. But personal guarantee of the director, this is commonly missed out. You'll have to read the entire sanction letter. Primary security, secondary security, in whatever terms is appearing in the sanction letter has to be mentioned in the financial statements. Second commonly observed error is, at least for property related loans or plant and machinery related loans, people disclose the security. But for loans such as vehicle loans, they miss onto it. It appears immaterial for disclosing the security. No, there is no distinction required. For each and every line item, you will have to disclose the security related details. Even if it is as basic as hypothecation of the vehicle, you will have to disclose the security related details for those particular borrowings what are appearing. Second point, for case of bonds and debentures, rate of interest is disclosed, but you will also have to disclose the redemption, when it is going to be redeemed, what is the mode of redemption, what are there any conversion options available. These points are also to be disclosed. with respect to bonds and debentures, which are commonly missed out. Thirdly, as per the amended Schedule 3, current maturities of long-term borrowings are shifted from other current liabilities to short-term borrowings right now. So even we have to be aware that this shift is made as per the revised Schedule 3 or the amended Schedule 3. So let us be cautious that this change is made, because in spite of 2 years 2 years done for the amendment, people are still missing on to these kind of pointers. Secondly, one more point to this addition to long-term borrowings is, wherever the short-term or long-term classification is there, so short-term or long-term classification, if in the current year the loan is getting reclassified as a current obligation, you cannot change the previous year amount. So previous year the loan was non-current. This year it is only having the current portion. You cannot disclose the entire amount in the previous year also in the current. So this kind of reclassification of the previous year's amount is commonly observed, which is an error in the financial statements or a non-compliance in the financial statements. Last year it was non-current. The terms as per the last year were non-current. In the current year, it is only 1 year what is left for the loan. So in the current year, it will be in the current. In the last year, it will have two parts, that is non-current and current portion of the borrowings. I hope this is clear with everyone. In case of any queries, if you have, you can note it down and we can discuss it at the end of the session. Thereafter, trade payables. In case of trade payables, obligations such as statutory obligations, employee-related obligations, asset purchases, or any other contractual obligations are also merged as a part of trade payables. Trade payables, friends, are core and correlated to purchase of goods or services in the ordinary course of business. Any other kind of payables are to be disclosed in other current or non-current, as the case may be. In that aspect, you have to disclose. You cannot merge everything such as statutory obligations, GST payable, PF payable, ESSC payable. Everything is not a part of trade payables. These all are to be disclosed in the other non-current or current, as the case may be, in the liabilities, other current liabilities or other non-current liabilities. Again, very peculiar, very common non-compliance which is made in the financial statements. Thereafter, with respect to provisions, in case of provisions, friends, the gratuity or actual valuation reports gives you the breakup of current and non-current aspect of the provision. In spite of the actual report giving you these kind of breakup, what do companies or auditors do is they disclose everything in the non-current part as one single line item, or it is observed that gratuity obligation is disclosed non-current and leave encashment obligation is disclosed in the current. No, you cannot change the classification on your own. The actuary has made the current and non-current portion based on the actual assumptions. And you will have to abide by those assumptions and disclose it accordingly. Thereafter, in case of these are common, ideally there are many errors. Each and every disclosure that you miss is a part of a non-compliance, honestly. But I have selected, considering the limitation of time, I have selected peculiar errors which are very common, so that at least these kind of common errors we avoid. Otherwise, we have 3 volumes generated by the FRRB for each and every error that the auditors are missing into the financial statements. Thereafter, in case of fixed assets, a commonly observed error is tangible and intangible items are merged as a single line item on the face of the balance sheet and disclosed as a single line item as fixed assets. There are 2 things in this. Firstly, the fixed assets nomenclature is no longer existing. After the amended AS 10, this fixed assets nomenclature is now converted into property, plant and equipment. So you cannot use the word fixed assets. You will have to use the word property, plant and equipment. Intangible assets have to be disclosed separately on the face of the balance sheet. If there is capital work in progress, that also has to be disclosed separately. Now, even in capital work in progress, they disclose intangibles and tangibles together. No, again, there are two line items, capital work in progress and intangible assets under development. These two are separate line items, have to be disclosed separately. Second, non-compliance in the area of fixed assets or property, plant and equipment is wherever you have given advance for any kind of fixed assets or any kind of construction of assets, it has to be classified under long-term loans and advances as capital advances given, and it cannot form a part of CWIP. You'll have to disclose it separately under the long-term loans and advances, and you cannot merge it with the long-term loans and advances. So this is a common error. Third, if you have leased assets, you have taken the assets on lease, it is under finance lease, or you have given the assets under lease, it has to be disclosed separately. You'll have to give it assets given under lease or assets taken under finance lease have to be disclosed separately. This classification is not made. These assets form a part of your land or building or as the case may be itself. So again, a very commonly observed non-compliance in the financial statements. So this has to be disclosed separately. Thereafter, moving ahead to the next line item, that is investments. In case of investments, wherever you have investment in associates or joint ventures, you will have to mention that these are investments in associates and joint ventures. It has to be titled as investments in associates, investments in joint ventures. You cannot just give investment in and the name of the company XYZ. No, it has to be disclosed as investment. The title should be there, investment in joint ventures, investment in associates. In spite of the fact that in the related parties schedule, you have mentioned that these two entities are your associates or joint ventures, it does not waive off your responsibility or your disclosure requirement to mention it in the investment schedule as investment in associate or in joint venture. Similarly, investment in partnership firms should be disclosed separately, and investment in LLPs should be disclosed separately. You cannot merge these two line items because these two are separate. LLP is a body corporate and partnership firm is a firm. So there should be classification between the same. Moving ahead, in case of inventories, disclosures in inventories. So a very commonly observed non-compliances, if a company is having traded goods, you cannot include traded goods as a part of your finished goods. Traded goods are to be disclosed separately as traded goods or say stock in trade. So these two line items are commonly merged and into a single line item called as finished goods. No, traded goods are to be disclosed separately. Wherever you have goods in transit, in any category, in raw material category, in traded goods category, in stores and spares category, in packing material category, in any category, if you have goods in transit, it has to be disclosed separately in your inventory schedule or as a note below the inventory schedule. But this line item should have separate amounts assigned to it. So these classifications in inventories are commonly missed out. Moving ahead to non-compliances regarding trade receivables. In case of trade receivables, wherever the aging requirement is there, even in the amended schedule through 3, even it was there previously 6 months classification. Now it is 0 to 6, 6 to 1 year, 1 to 2 years, and 2 to 3 years and above. So this classification has to be made from the date of it is erroneously made from the date of the invoice, whereas the Schedule 3 requires it to be from the due date of the payment. So this is a commonly observed non-compliance, that they make it from the date of the invoice, because date of the invoice is easily there in the system and they just generate the aging from the date of the invoices. Secondly, the trade receivables includes the amounts due on account of fixed assets, includes the amounts due on account of sale of investments, or any other obligation which are not in the ordinary course of business. So no, this you have to disclose it separately as a part of other current assets, and you cannot merge it with the trade receivables. Moving ahead to cash and cash equivalents. In case of cash and cash equivalents, so this particularly includes cash and cash equivalents. Please understand the nomenclature. If you have fixed deposits is a part of other bank balances. So you cannot merge the fixed deposits in cash and cash equivalents. Which fixed deposits go in the cash and cash equivalents is where the original tenure of FD itself is 3 months or less. Original tenure. Please remember original tenure and not the balance tenure. So as on 31st March, I cannot say whichever FDs are maturing up to June. These are only up to 3 months, so I'll include it in the cash and cash equivalents. No. The originally itself, the FD should be created for 3 months or less. Only those fixed deposits will form a part of cash and cash equivalents, and not all the FDs which has a balance tenure of 3 months or less. Secondly, if the FDs is having tenure, say below 12 months, it has to be forming a part of other bank balances, which is a separate line item. It can be current or it can be non-current. So greater than 12 months will go in the non-current portion. Earmarked balances such as unpaid dividends, people have accounts for CSR compliances. So CSR requires wherever you have unpaid amount of CSR, you'll have to transfer it to a separate bank account. So these are earmarked balances for dividends, for CSR, or for any other earmarked balances have to be disclosed separately, and you cannot include it as a part of your bank balance as a part of your cash and cash equivalents. You have to disclose it separately with the nature for which it is earmarked. If it is for dividend separate, CSR separate, for everything it should be separate. Non-compliances on disclosures regarding loans and advances. So in case of loans and advances, again, if you have multiple categories of loans and advances, such as say loans to employees, your dealer loans, or whatever the case may be, if there are any bad or doubtful debts, for each and every item, you'll have to disclose separately whether there are any bad and doubtful debts. You cannot merge it as a single line item below the entire schedule. So that is one important aspect. Common non-compliances, they show it as a single line item below the schedule wherever there is a provision for bad and doubtful debts. In case of any related party balances, has to be shown separately for the loans and advances. Thereafter, these are the common non-compliances. Mainly the non-compliances are relating to the balance sheet items. I'll separately cover the P&L items as a part of the accounting standard non-compliances. So firstly, let us cover the depreciation. Non-compliances regarding the Schedule 2, that is the depreciation schedule of the Companies Act. So friends, a very commonly observed non-compliances. In case of depreciation, lives are prescribed by the Schedule 2. The companies can deviate the lives prescribed by the Schedule 2, supported by technical evaluation. But in case of any deviation from the Schedule 2, the companies have to disclose in their significant accounting policies that for these all nature of assets, we have deviated from the Schedule 2. Schedule 2, life as per Schedule 2 is say 10 years, and life as per our technical evaluation is 12 years or 8 years, whatever the case is. So this disclosure is commonly missed out by the companies. In their depreciation working, they use different lives, but they do not disclose it in their significant accounting policies or by in any form in the notes to the financial statements. Thereafter, it is a requirement of the Schedule 2 as well as the accounting standards that depreciation needs to be computed from the date of addition. Commonly observed non-compliances are they provide for the entire year. So even if it is the addition is made in any month, depreciation will be for the entire year. For ease of calculations or for whatever ease this is made, or in case of deletions, they don't provide it in that year. So if the deletion is made in the month of June, ideally as per the standard and as per the Schedule 2, you should provide the depreciation up to the month of June. This is very, everybody's aware about this concept, but while computing in the financial statements, they miss on to the depreciation up to the period of deletion or up to the date of deletion. So additions or deletions, up to the date of addition or up to the date of deletion, depreciation should be provided. Thereafter, we'll cover now one by one accounting standards, so which will cover your P&L items and other related calculation items. I hope you all are with me and you all are understanding the non-compliances. In case of AS3 cash flow statement, if you have the financial statements have line items such as foreign exchange gain, foreign exchange loss, but no adjustment is made regarding the same in the cash flow statement. So if there is an unrealized portion of the foreign exchange gain or loss, there is an impact in the cash flow statement. It becomes a non-cash item and it has to be adjusted in the respective trade receivable, trade payable, wherever the baseline item lies to it. So this is commonly missed out in the cash flow statements. Unrealized forex gains or losses are not given impact for in the cash flow statement. Prior period items. In case of prior period items, accounting policies of the company, this is mentioned in the accounting policy wherever the case I have mentioned. Accounting policies of the company state that we have included prior period items in the respective expenses and incomes. It is not allowed. Prior period items have to be disclosed separately as a separate line item in your expenses note or as respectively applicable note. And in case of Ind AS, prior period items have to be restated in the respective period for which it pertains to. So restatement is required under Ind AS, and under your AS, it has to be disclosed separately. You cannot merge it into the respective expense or income items. Secondly, another line item is, so in case of appropriations, so appropriation concept is way back waived off or removed from the accounting standards. But still in the P&L, they show it net profit for the period. Thereafter, appropriations at the end. And in the appropriations, they show provision for earlier year taxation. It's not an appropriation. Provision for earlier year taxation is nothing but prior year taxes. It has to be included as a part of tax expense itself, where you show current tax, deferred tax, and prior year taxes. Even as a part of appropriation, companies disclose line items such as write back of debts, sales tax dues, any assessment dues, any income tax survey dues. No, these are not your appropriations of your net profit has to be impacted for all these line items, and you cannot show these line items as a line item below the net profit as appropriation. Absolutely incorrect practice, which is commonly observed. Thereafter, you have AS7. In spite of many companies being into construction contracts, still their accounting policies disclose policies such as the revenue from the construction contracts is accounted for on the basis of running bills raised and approved by the clients, and expenditure is accounted on accrual basis. No. Revenue in case of construction contracts have to be disclosed based on the stage of completion. There is a complete standard for that. You cannot disclose the revenue on your billing basis. So it has to be disclosed on the stage of completion. Various other disclosures are there regarding the construction contracts, such as what is your profitability till date, how many are your total contracts till date, what is the advance amounts received, what are the retention amounts. These all amounts have to be disclosed as a part of disclosure. These disclosure also missed. There is a disclosure regarding amounts due to customer, due from customer. So unbilled revenue and unearned revenue amounts are also to be disclosed in the notes to the financial statements. A very detailed note is required to be given wherever there is a construction business involved. So these notes are also skipped in the financial statements. Thereafter, in revenue recognition, as common as if it is the entities into an educational business, which is charging subscription fees, you cannot say that in this case, the annual report of the company disclosed that revenue from our educational services is recognized on receipt of subscription fees. No, you cannot follow receipt basis for any kind of revenue recognition. Revenue has to be recognized over the period over which the services are provided. Now, there are two aspects over here. Sometimes the companies may be accounting for in appropriate manner. Numbers may be correct, but people don't focus on the wordings they have used in the accounting policies. So your accounting policy cannot say that revenue recognition is on receipt basis, not at all. You will have to use the appropriate wordings from the appropriate accounting standards and apply those accounting standards also when you're recognizing the revenue, when you're measuring the revenue for your financial statement. So both should be in line. So your accounting policies should also be in line in which the accounting treatment is given. Many times, a lot of copy pasting is done from the standard listed companies. And in that copy paste thing, a lot of accounting policies are missed. Whatever the company is not following, that is also mentioned in the accounting policy, and a lot of blunder is made in that. So word to word, the wordings of accounting policy are to be focused upon, because that represents what the company is doing for the purpose of measuring recognition of their income, expenses, assets, and liabilities. Thereafter, again, in case of dividend income, a commonly observed error is dividend is recognized as and when received. No, dividend has to be recognized when right to receive the dividend is received. So these kind of language in the accounting policy, as well as the corresponding accounting on receipt basis, both is not permitted and a very commonly observed error in the financial statements. Moving ahead, for AS 11. So in case of AS 11, many companies disclose that the foreign exchange revenue or expense or the transactions are recognized on the transaction date as per the customs rate. So customs rate varies in 15 to 20 days. In 15 to 20 days, the rate of exchange is same for customs. You cannot use that same rate because it is same for 15 days or 20 days. So you'll have to use the rate that is prevailing as on the date of the transaction. AS 11 requires you to use that particular rate, which is prevailing as on the date of transaction. Thereafter, accounting policies of the company state that assets and liabilities, current assets and current liabilities are translated using the closing rate as on the balance sheet. All assets and liabilities are not required to be translated. Only monetary assets and monetary liabilities are required to be translated. So accordingly, even your accounting policies should state that, and your accounting should only restate monetary assets and monetary liabilities as on the closing balance sheet date. Moving ahead to government grants. In case of government grants, even if the grant is related to an asset, still companies have treated or transferred the grant to capital reserve. And on a periodic basis, based on the depreciation, they transfer the amount from capital reserve to the surplus in the statement of P&L. Absolutely incorrect accounting and incorrect accounting policy. If it is asset-related grant, the grant should be reduced from the value of the asset or disclosed as a separate line item called as deferred income on the liability side. And periodically, you can transfer it to the P&L per se. So this kind of accounting practices, and this is even in Maharashtra per se, many subsidies, PLI subsidies, every state has their PLI related subsidies. Companies feel that since the subsidy is relating to my factory that I'm creating over here, it becomes a capital reserve. No, you cannot transfer it to a capital reserve. It is your asset related grant and it has to be recognized on net basis or gross basis as permitted by the AS 12. AS 16, borrowing cost. In case of borrowing cost, what kind of policies companies follow is the inventory includes interest amount and any kind of direct expenses. Your inventory cannot include interest amount unless it is a qualifying assets. So your normal CC borrowing rate or your OD borrowing, your cost of finance cannot be included as a part of your inventories unless your inventory is a qualifying assets. So inventories which themselves take a substantial period of time to get ready, over there the borrowing cost you can capitalize for inventory items such as wine, liquor. These items take substantial time because it requires a lot of storage tenure. In other cases, you cannot capitalize the interest amount. Secondly, the policies that mentioned, they do not give you a clear picture about when the borrowing cost capitalization has started and when the borrowing cost capitalization has ceased or ended. So the policy should clearly mention when it has started and up to the point of which point of time up to which you have capitalized the borrowing cost. AS 18, related party disclosures. In case of AS 18, a lot many classifications are required to be given. You have to disclose advances, even if companies have seen that these classifications such as advances are given to directors, loans are given to directors, ESOPs are there. So these items are seen from other line items in the annual report because lot many AOC 4 forms are to be disclosed in the annual report. Such forms give you the information that there are loans given to directors, remuneration is given to directors, ESOPs are given, but the RPT schedule, related party schedule of the company, of the financial statements do not disclose these kind of line items. No, there cannot be mismatch. So you're missing out to give this information in your related party schedule, which is again a non-compliance. In case of leases, a huge rent expense is appearing in your expenses. But lot many additional disclosures are required by AS 19 and even by Ind AS 116. Disclosures such as minimum lease payments up to 1 year, 1 to 3 years, more than 3 years. These kind of disclosures are not given. What are the significant terms of lease? What are the arrangements of lease? Whether you have any sublease, these kind of additional disclosures are not mentioned in the notes to the financial statement, which is a mandatory aspect. So rent expense is there, it should be corresponded by these kind of disclosures in your notes to the financial statements. AS 22, that is deferred taxes or accounting for taxes or income. Peculiarly, the policies of the companies show that, I'll read one policy. The company has disclosed that deferred tax and current tax are not recognized in the absence of book profit. No. In case of deferred tax asset, you have a condition that for losses and for unabsorbed depreciation, you'll have to recognize a deferred tax asset only when there's a virtual certainty. In case of deferred tax liability, mandatorily, you'll have to recognize a deferred tax liability. So you cannot waive off from recognizing deferred tax asset or liability just because company is not having a profitability. If there's a liability, mandatorily you'll have to recognize a liability. In case of assets pertaining to unabsorbed losses and unabsorbed depreciation, virtual certainty. For other assets, to the extent of deferred tax liability, you should recognize the deferred tax asset in your financial statements also. Thereafter, companies show deferred tax asset and deferred tax liability separately in the balance sheet. For the same company. So deferred tax assets and liabilities with respect to the same entity are netted off because because offsetting is allowed in this particular case. When you're preparing a consolidated financial statements, your holding company is having an asset, your subsidiary company is having a deferred tax liability, then obviously offsetting is not allowed because these are two separate entities. And as per the governing laws, you cannot offset. That is why in that case, it is okay when you're preparing a CFS, asset and liabilities are disclosed separately. But in other cases, in this case of same entity, you cannot show it separately. You will have to offset it and show it as a single line item in your non-current portion. Deferred taxes are never current or never have to be bifurcated also into current and non-current. AS 26, intangible assets. One very, very, very common error is whenever the companies have been recently started, all the preliminary expenses such as license fees, setup fees, initial seed marketing expenses, research expenses are still capitalized into the balance sheet as deferred revenue expense or as preliminary expense or as whatever name per se and amortized over a certain period. Not absolutely permitted. Long back, AS 26 was amended and these kind of line items are no longer permitted to be disclosed as an asset into your balance sheet and amortized. Not at all permitted. These are purely period expenses and are to be expensed out in the respective year itself, in the year in which you incur itself. Just because the companies have not started its operations, all this setup cost cannot be capitalized or cannot be termed as your deferred revenue expense or any kind of intangible asset per se or in any asset form per se into your balance sheet. Not permitted at all. AS 29, provisions. Very commonly observed error is bank guarantees. Bank guarantees given are disclosed as contingent liabilities into your financial statements. No, these are not your contingent liabilities. Bank has given you a guarantee. When do you take a bank guarantee? For your own performance, you take a bank guarantee. So this is your own obligation. For instance, I'm going to purchase goods or I'm going to import goods against which I have taken a bank guarantee. Serving your import obligation or serving your export obligation is your primary liability. And if you default, the vendor or your customer can exercise the bank guarantee and request the money from the bank. So your own primary obligation cannot be disclosed as a contingent liability because it is for your own performance itself. Once the bank guarantee is invoked and bank is collecting the money, bank will eventually recover the money from you. At that point of time, provision amount may arise, but not when purely bank guarantee is taken and there is no invocation of any kind of bank guarantee. Very common error that is there in the financial statements. Lastly, I think this is the last error itself. In case of provisions, there is a proper definition given in AS 29 for provision for expenses. So provision for expenses are wherever timing is uncertain or the amount is uncertain. Still, people disclose line items such as provision for telephone bill, provision for electricity, provision for audit fees. Also as a part of provision, these are not provisions. You already know the amount. You know when the amount is to be paid. Everything is known. It is just accrued expenses that you're recognizing. Just because generations by generations, these line items are termed as provisions, even the financial statements disclose line items such as I said, provision for audit fees, provision for telephone bill as into the provisions. These are not provisions. These are just accrual for the services that you have already received, which are to be part of trade payables. Only line items such as gratuity, the respective provisions per se, provision for warranty, these kind of line items are a part of the provisions. So please be careful. Again, this is a very, very, very common error that we commonly tend to disclose in the financial statements. So I hope, friends, the session was interesting and you all have understood and you will be careful about these kind of errors into your financial statements so that we as a fraternity as a whole will have more qualitative financial statements and more, accurate financial statements will be there in terms of disclosures, in terms of compliances with accounting standards, and in terms of all the disclosures required by the Schedule 3, Schedule 2, whatever content we have. So in case of any queries, please email me on the email ID given on the screen, or you can also WhatsApp me on my mobile number. So thank you so much. This is about my session today, and hand over to you.
Thank you, ma'am. It was a really great session. We have few questions from the participant. The first question is, a founder member, erstwhile promoter, has exited the company 2 years ago, now holds no share of entity. Is disclosure required for such person?
So as on a reporting date, whoever are the promoters of the company today are to be disclosed. He has exited 2 years back itself, so no disclosure required for the same.
The next question is, capital advances from bank given for construction purpose now waived off. Will this be reclassified in PPE CWIP?
Capital advances given by bank.
Yes.
So that is your loan obligation and the bank has waived off the same.
Yes.
Bank has waived off the obligation that you have. Will it be classified as PPE? So it is your money taken already. You will have already purchased the asset with respect to them. So already a PP will be appearing for that now. So this will be repetition of the capitalization. So this won't be permitted. Any kind of waivers will be routed through your profit and loss, and it won't be again capitalized because already the asset whichever you would have purchased is already capitalized in your PPE section. Because money you would have received from bank and you would have purchased an asset. So double capitalization for the waiver portion, I don't think it is logical.
Thank you so much, ma'am. It was a really insightful session. I'm very sure आपने दोनों क्वेश्चन के जो आंसर भी दिए हैं like the participant must have been satisfied. So we'll wait for 2 minutes if we have any other question, or else we'll proceed for the closure of the session.
Sure. No problem.
I request the participants, if they have any question, they can please write to us the questions. Yeah. So I am CA Deepika Gurgutia. Good evening, ladies and gentlemen. I stand hereby with immense gratitude and honor to express my heartfelt thanks on behalf of the Women and Young Member Excellence Committee for the incredible webinar we just witnessed. This event would not have been possible without the support and dedication of some remarkable individuals who deserve our utmost appreciation. First and foremost, I would like to extend my deepest gratitude to CA Preeti Savla ma'am, the chairperson, and CA Abhay Chajar sir, vice chairperson of our committee. Your visionary leadership and commitment to the empowerment of women and young members in our profession have been truly inspiring. A special word of thanks goes to CA Praveena Oswal for our introduction of our speaker today. Last but certainly not least, I would like to extend a heartfelt thank to our esteemed speaker, CA Shita Doshi. Your expertise in the field and ability to captivate our audience with your profound knowledge were truly remarkable. To all the attendees, thank you for being a part of this webinar. Thank you to the technical team for helping us have a flawless webinar. Once again, a big thank you for everyone making this webinar a resounding success. Thank you so much.